Good morning, everybody. Thanks for coming. I'm Denise Smith. I'm the Dean of the School of Business and Economics here at IU East. Welcome to IU East and the Kelley School of Business Outlook Forum for 2023. I'll be your moderator this morning. The campus is honored to have hosted this event for over 30 years and to provide this insightful information to our community. We are thrilled to be here face to face. Joining us today is interim Vice Chancellor for External Affairs, Todd Duke. So welcome. And we thank the Director of Alumni Relations, Terry Wiesehan, for all of the organization for this. This morning you'll hear remarks regarding national and international business, financial markets, the outlook for the state of Indiana, as well as the local business and economic report. Following these offerings, the panelists will take questions. If you have a question at that time, please raise your hand and a microphone will be brought to you. I see I neglected to introduce Interim Executive Vice Chancellor for Academic Affairs, T.J. Rivard. I don't know how I missed you. Sorry. I'd like now to introduce our panelist, Kyle Anderson. Dr. Anderson is a clinical assistant professor of business economics at the Kelley School of Business in Indianapolis. He has an MBA and a PhD from the Kelley School of Business. Did I do something? Okay. Jennifer Rice is a senior lecturer of economics and public policy at the Kelley School of Business, Indiana University, Bloomington. She received her PhD in economics from Indiana University in 2004. Bill Powell. Dr. Powell is the academic director of the Indiana Business Research Center and the Daniel C. Smith Faculty Fellow at the Indiana University Kelley School of Business. He also serves as Associate Dean, managing the portfolio of academic programs on the Indianapolis campus. Dr. Powell received his PhD in economics from Vanderbilt University in 1995, following his undergrad work at the University of South Carolina. Oi-Lin Chung. Dr. Chung is a professor of finance at IU East. She earned an MS and a PhD in financial economics from the University of New Orleans, Louisiana, and an MBA from the University of Macau, China. She is currently the director of the IU East Business and Economic Research Center. Welcome, panelists, and thank you for being with us this morning. I will now turn this over to our panel for their insights, and again, there'll be time for questions following their presentations.
All right, hello. I don't know if I'm going to need that too much, but thank you for coming, and I'm very happy to be here to present the U.S. and global economic forecast. To start off with, let's just briefly review where we are today and where we've gotten here, and then talk a little bit about where that will affect us or where that will take us going into 2023. So over 2022, we have grown as an economy, but the rate of growth has slowed the last couple of quarters. The deceleration was much slower than what we expected, resulting in us being at a point today that was not where we expected to be when we did this forecast last year. The question is why? Why have we gotten to this point? Decrease in consumer spending, business investment, housing construction, government purchases were all lower than expected. The big thing is inflation. At this point last year, many of us thought that inflation was going to be transitory, but it has now become permanent and much more pervasive and persistent than we ever expected. As a result of that persistent inflation, we've seen an increase in interest rates. In this last year, we've seen a higher single-year increase in total increase in interest rates than we have in over 40 years, at 3.75 percentage points. Also, the labor market. We have a very tight labor market. Lower labor force participation rate, low unemployment, results in a shortage of workers. We have a very tight labor market. In addition to that, we're continually having supply chain issues and distortions that we have seen over the last couple of years, and the uncertainty with the war in Ukraine has caused supply pressures, price pressures on energy prices, food prices, natural resources, and so forth. So the question is, how does all of that affect where we're going to in 2023? Well, it affects it a great deal. So what is predicted to be the forecast for 2023 globally is that there will be some slight growth, about 2.7%, with advanced economies growing at a slower rate than those of emerging and developing countries. And the U.S. coming in about 1 to 1.5%. Okay, so let's focus on the U.S. Our outlook that we have created for 2023 suggests that we may have weak growth at best, but even possibly negative growth. So basically, there's so much uncertainty going on right now. It's one of the hardest forecasts we've had to do. So it's basically, to pinpoint an exact forecast is pretty challenging. So rather what we've done is we pretty much have two possible scenarios based on assumptions. A very optimistic, happier forecast versus a pessimistic forecast. With the optimistic forecast looking at about 1 to 1.5% growth. So definitely, somewhat of an economic downturn, but a little bit of a growth going, but very weak growth. Unemployment hitting a mid-year peak about 4.5%, and an increase in employment of a little bit under 1 million jobs. On the other hand, the pessimistic forecast suggests that we could have negative growth at or above negative 2% for a couple quarters. Year-end unemployment up to 6.5%. And rather than an increase in almost 1 million jobs, we could have a decrease of almost 3 million. So you can see there's quite a bit of a difference in basically having a mild economic downturn to a pretty significant recession. So there's so much uncertainty, so what's going to determine which side we're on? Because that's a big range, right? That's a big range. So what's going to determine that? Basically the same factors that caused us to get to where we are today. Inflation and interest rates. If inflation continues to rise, we continue to have tightening monetary policy. As a result, the cost of borrowing money is going to increase, real income is going to decrease, and as a result, how is that going to affect consumption, U.S. consumption, especially consumer spending, right? Higher cost of borrowing money to buy things, lower real income. The big key here is how much is consumer spending going to fall? If consumers decide to use some of their excess savings that they have saved through the pandemic with all the stimulus money, the extra money coming in where savings increased tremendously and some of that's left, if they continue to use that to maintain somewhat of a consistent or smooth consumption pattern, we're going to be at the better end, right, of just a weak growth. However, if consumers decide to start pulling back and stop spending, because of the higher interest rates, then we're going to be towards the more severe pessimistic area. Also, another thing affecting that is the distribution of consumption on services and goods. During the pandemic, most of the consumption switched, or there's a significant amount of consumption that switched from consuming services to goods, and partly because of the lockdown, right? People couldn't go out, we couldn't consume services. So because of that, we started to see an increase in the price of goods, and we've seen that. So the inflation in services hasn't kept up with what is going on in the goods, primarily because of the demand. But what's going to happen is, now that the economies are opening back up, are we going to see a shift back to services, right? Are we going to see a shift back to people consuming more services, given that we are a service economy? And if so, how is those goods industries going to react to that lower demand? Okay, especially with the number of workers they have. Are they going to hoard their workers? Are they going to lay workers off? How are they going to respond? So you think about it, we're talking about a lot of uncertainty, and you have to, people say, but why not know what they're going to do? Well, we're explaining human behavior, right? As economists, that's what we do. We're trying to predict what people are going to do. And there's so much uncertainty with what's going to happen with these different factors. Another one is the tight labor market. We do expect the growth in the labor market to slow and possibly lose some jobs. But, optimistic, we could increase the number of jobs some. But our labor market is so tight right now with a lower labor force participation rate, lower unemployment, that could potentially put pressure on wages, right? So we put pressure on wages, it's going to maybe put some pressure on prices. So how is that going to, affect the current inflation we already have? Globally, there's factors that could potentially affect our outcome as well, depending on whether we're going to be weak growth or negative growth. One is the uncertainty with the war in Ukraine, right? We don't know what's going to go on there. If, that is putting strong pressure on supply of natural resources, energy, commodities, food. And not only that, that's also then putting pressure on prices. So that would contribute to inflation as well. Continued supply chain disruptions. We had issues with inflation starting before last year due to supply chain disruptions, right? We were having trouble. The automotive market is a prime example of that. How, because of not being able, the chip market is basically what started a lot of this. And not being able to get those inputs to produce the goods was driving prices up. So we saw inflationary pressures happening before, this summer or early this spring due to supply chain issues as well as that tight labor market. One of the last things that could really affect what happens in 2023 is weaknesses abroad in other countries. We know what's going on in Britain, but also China. China is a key one to look at because they are a significant source of manufacturing for U.S. imports. China is having an issue themselves in the real estate markets. Their real estate market is almost like a bubble, right? They're worried that it's going to end up crashing. It's going to end up being a banking crisis. Real estate market and sales has already started to fall. The resurgence of COVID, very strict COVID restrictions in China, has had a drastic effect on consumer confidence and consumer spending. So even though China is going to experience or forecasted to have about a 4% growth, that's half of what they have been having, around 8%. So what happens in China could have a drastic impact on inflationary pressures and output growth here in the United States. So overall, what's our conclusion? Our conclusion is that we're optimistic, right? It is possible saying, hey, we might have some weak growth in 2023. A little bit below trend growth, below what we've seen in the past, but a little bit, 1 to 1.5%. But at the other end, it could be a pretty significant recession. And as I said, to summarize, it basically depends on how consumers, governments, firms are going to continue to react to higher interest rates and how they respond in terms of their spending and consumption. And that's going to be a key factor in determining which side of the spectrum we end up in 2023.
Thanks, Jennifer, for that optimistic outlook. It didn't feel that optimistic, but I get to talk about the financial markets, so that's going to be a bundle. If you're anything like me, some of us, older generation, right? You probably have some of these that you still get in the mail, even though they want you to, get it by email. And if you're also anything like me, you probably got a lot of these sitting around that you haven't wanted to open this year. We kind of know what's in it, right? Like it's the old, I know what's in there and it's not good news. And so I'm here to help you exercise those demons. Just whatever you do, go home tonight and throw them away. Just get rid of them. It's ancient history. It's not going to help you. It doesn't matter what's in there. Just put that away, toss it in the garbage. The markets, whatever you're invested in, it's probably not been good this year. So the S&P 500 is down about 17% so far year to date. But it's not just that. The NASDAQ's down even more, not surprisingly, about 25%. Broad-based bonds are down. There's been no real savior from diversification this year. Almost all asset classes have been down. And, we always hope, and it's still a good strategy to be diversified in your investments, but it hasn't really helped very much this particular year. You could be investing in crypto, like I hope you're not, other fictitious currencies. But markets are forward-looking. And so we shouldn't worry about what's happened in the past. We ought to be thinking about where we're heading. Good news and bad news, right? The bad news is it's very hard to predict. The good news is we've probably absorbed a lot of the pain. If we think about a typical cycle, we look at the stock market as a leading indicator. So the potential for a recession that Jennifer talked about that is, may or may not, but definitely a slowdown that will occur in 2023, that's probably already priced into the market. And so what we've seen a lot of this fall is actually decent company earnings, but stock prices have fallen because the market expects earnings to go down next year. And all of that means is if you're thinking, oh, that doesn't sound like a great forecast, maybe I should sell my stock, well, you're too late, right? And so whatever your strategy was a year ago or 2 years ago, if that was a good investment strategy, it's probably still a good investment strategy to this day. So what's driving a lot of this? We talked a little bit. I put together these notes last Wednesday. Thursday was an interesting day. We had inflation numbers from October. Those numbers, even though some of the headlines were quite strong, the actual underlying numbers were pretty good. And the way to interpret that is the number from inflation from September to October only went up by about a 3.5% annualized rate, which is a good number. Now, most of the way that inflation gets reported is a year-over-year number. That number wasn't great, but it was one good data point to say that maybe we have hit peak inflation and we're at a phase called disinflation, which is not deflation. It's not prices coming down, but inflation at a slower rate going forward. That's what the market responded to. Of course, we've had a few blips of good data over the last year and a half, but overall that story hasn't held up. So we'll see what happens. The reason the stock market responded so favorably last week is the anticipation that maybe the Fed will be a little bit less aggressive going forward. So maybe a 0.5% interest rate at the next meeting in December, although there will be another monthly reading before that decision gets made. So there may be some tea leaves there that suggest that maybe we've hit peak inflation and that number will be coming down over the next year, which would be welcome. Interest rates, we're well aware, have gone up. We expect the federal funds rate to hit about 5% before they kind of cap out on that. So there's still some tightening to go. From a broader economic perspective, the 30-year mortgage is around 7%. That number, I kind of punched into a mortgage calculator. Many of you are probably aware of this if you're in the banking industry. A 30-year mortgage, just punching in some kind of average numbers, the typical payment is up 37% from what it was a year ago. And so we're going to see a housing market slowdown, and that will likely be affected in both house prices and in sales volume. It just has to happen, and that's going to slow down the economy. Housing sales also drive a lot of other durable goods purchases. The other thing that I think is really important to kind of keep in mind, we've got a strong dollar right now. The dollar is up about 17% against kind of a trade-weighted basket of currencies. It's good for us if we're importing goods, if we want to buy our French wine or our Italian goods or Chinese goods, if we can get them, right? That may help hedge inflation a little bit on the goods side, and we're seeing some of that. The trade-off is that Indiana is a large manufacturing and exporting state relative to the size. Our exported goods are going to get more expensive, and that's going to put some pressure on Indiana manufacturing. A final note, as kind of returning to the investment side, I wanted to go back and look. We've heard a lot about, the highest inflation we've had in 40 years. Some of us are old enough to be around in the late 70s and early 80s and remember a little bit of what that period was like. But I wanted to go back and look at the numbers. And so from the start of 1979 to the end of 1983, it was a 5-year period. During that time, we had lots of inflation, and then the Fed finally responded to get it under control. The federal funds rate hit 20% at its peak, right? We had 2 recessions in that 5-year period. And yet the S&P 500 was up double digits 4 out of those 5 years. And the 1 year it was down single digits. It wasn't some crazy thing. The cumulative return at an annualized rate over that 5-year period is about 11.2%. Now, of course, when you have inflation, that your real return is going to be less than that. But the point is, even during that very troubling economic history, being invested in the stock market was a reasonably good investment during that time. And so even if you're thinking kind of doom and gloom, there's probably value in maintaining a stock portfolio throughout your investments. The markets are forward-looking, and unless we end up with a really worst-case scenario, there's a decent chance that we'll see a pretty good recovery in the markets. With that, I'll turn it to Phil to talk about the Indiana economy.
Thanks, Kyle. Can y'all hear me? Good morning. How we doing? So let's bring it home to the great Hoosier State, and I want to build off what Jennifer said. So we've laid out either a hard landing or a soft landing, right? Our soft landing, our economy grows, but it grows more slowly at about 1 to 1.5%. Our unemployment rate goes up about a point, and things start to get better after the second quarter. Our hard landing suggests that our economy shrinks 2% on an annualized basis, and that really the pain drags through at least the third quarter, and unemployment goes up about 3 points. So I want to give you something to watch out for as you go through the year, and then I'll talk about how this impacts the state, because it's important. It has a disproportional impact on Indiana. Watch what happens with holiday spending. As Jennifer said, households are pulling from what economists call excess savings that was accumulated during the pandemic years. Our savings rate went way up simply because folks couldn't get out, or it could have been fear, and also the stimulus. The good news is that's fuel that consumers can use collectively. They don't know they're doing it, but if they continue to spend that money through this year, it's going to create the soft landing. And what's interesting right now with the economy is that typically it's businesses that take us into a recession, and it's businesses that take us out. Typically business spending that determines whether or not we have a hard or soft landing. Right now it's households. And so the soft landing occurs is if consumers continue to spend their money and they don't get fearful, right? And we're in the heart of an uncertain period right now. So the consumer behavior that we see during the holiday season is going to be very suggestive of what we're going to see from households as we go into the first 2 quarters of 2023. So if holiday spending is robust, if it's above expectations, if retailers are happy, that suggests soft landing coming. If retail sales and even Amazon or online sales are below expectations for holidays, that means households are pulling back, and we can expect a hard landing going into a cold winter. So now, what does that portend for the state of Indiana? Well, as you know, if you've come to these before, the state of Indiana has the highest density of manufacturing of any state in the union. And that's also, you know, our Ohio's very close to our intensity, as is Michigan and Kentucky. So we're in a manufacturing heartland. It's a heartbeat of our state economy. Indiana typically takes a hit. If there's a hard landing, we typically take it earlier than other places. But when we hit, we don't hit as hard as other parts of the economy. Our lows are higher, and our highs. Our bad days are not as bad as the rest of the country, and our best days are not as good. Right? Typical Hoosiers. We're kind of average. It's a well-diversified economy. We're even well-diversified in manufacturing. But there's a couple, you know, if consumers continue to spend money, there's a couple other things working in our favor. A lot of our manufacturing is connected to automotive, right? And if you've tried to shop for a car lately, you know that there's a huge backlog, right? And this huge backlog will continue. We'll see the car factories continue to produce, even though we have economic retrenchment going on in the rest of the economy. You know, typically automotive takes a huge hit, but maybe the silver lining of the backlog that we've experienced the last couple of years and the high prices is that this will give a chance for the automotive sector to catch up. There's two big headwinds, though. Kyle mentioned exports. We're one of the top 10 exporting states in the union, and that's a lot because of our manufacturing. So high dollar, anytime you have high interest rates, there's a high demand for the dollar because folks outside the U.S. want to invest in the U.S. because of a high rate of return here relative to other parts of the world. So high interest rates, high U.S. dollar, that's good for travel, but it's not good if you want to export something because it makes our products less price competitive. But a couple of things work, and then also pulling us back is labor shortages, right? Indiana's unemployment rate typically runs about a point below the country, right? And I'm sort of rounding, but basically right now, the U.S. is about 4%, Indiana is about 3%. Other good news on the labor front is that in a lot of parts of the country, their labor force is still smaller than it was in 2019. The good news is that our labor force participation rate in Indiana is a point higher than the rest of the country. Hoosiers have come back to work. No surprise there, right? So what's going to be interesting, if we do have a hard landing, if we do have shrinkage in the economy about 2%, we're not going to see the type of painful, pervasive unemployment that we've experienced in the past. Now, if you lose your job, it is a catastrophe. I don't want to minimize that impact. But even though we have the hard landing, our employment is going to remain robust here in the state of Indiana. So moving to my last point, you know, really, I mean, when we talk about a state economy, it's really a geographic aggregate of different regional economies, right? I mean, the structure of the economy here in Greater Richmond is much different than up in South Bend or New Albany or Indianapolis or Tippecanoe County, right? So the question that business leaders and policymakers in this region need to be asking from the state is, what can you do to make our region competitive, right? At the end of the day, it's about attracting a talent. 20 years ago, the economic development formula was what? You go off and you recruit big companies and you recruit big plants to come to your town, and then the talent follows. Actually, it's flipped. It's more important to attract the talent, and then the factories and the businesses come. And so when we're looking at Greater Richmond, what can policymakers do to make this an attractive place for talent? So the state of Indiana can do four things. And we're about to have a budget year. Our General Assembly will convene in January. And we'll come together, and they're going to have the wind behind their back. They have a $6 billion surplus coming in. That's been the advantage of the economic growth that we've had. So there's four things that your state legislators or the state government can do to make Greater Richmond more competitive. They can invest in education. anywhere from early childhood or free kindergarten to great investment in great campuses like this here at IU East. The second thing they can do is infrastructure, right? Roads, especially with manufacturing. When you have a big manufacturing base, logistics is right behind them in terms of an important industry. Good roads, good bridges. It's a place where our state can make a good investment. The other two things would be public health. This is where Indiana really struggles. We're in the bottom 5 in terms of investment by state government in public health infrastructure. And that's one small contributor, along with others, that we're not exactly Hoosiers are not exactly the healthiest folks in the U.S. And that's a business problem, right? It leads to lower productivity and higher insurance premiums, which some of your businesses may experience. And lastly, placemaking, right? Parks, great architecture, sort of the what some folks call the furniture of a region, right? Is that make it a great place to live, to attract these two new college graduates, especially graduates from this campus who want to stay here in Richmond. And so that's the question to ask of your legislatures. But as we go into this next year, our state does have a surplus. It does have the ability to make those investments. And for the state, we're going to do okay. The first 2 quarters are going to be a little bit of a pause. Manufacturing could take a bit of a hit in terms of demand. There could be some layoffs there, but in some ways it'll give our industries a chance to reset themselves and set them up for the recovery that will come pretty quickly. So with talking about Greater Richmond, I'll hand it over to, we can talk about the local economy.
Thank you, Phil.
Sure.
Hello, can you hear me? Just try to test whether you can hear me well first. Sorry. Because this is a new platform for me. If I cannot do well, bear with me. In this brief presentation, the Richmond region consists of the 7 East Central Indiana counties, including Fayette, Franklin, Henry, Randolph, Rush, Union, and Wayne. And because I do not have much time to go over the individual states, so I just go over the region as a whole. So you can see the information for the individual state, and then I just talk about the region. Wayne County's labor force was made up of 30,025 people in August 2022. This represented 31.13% of the region's total labor force of 96,457 people. The county's January to August monthly average labor force in 2022 was 29,521 people. This showed a decline by 0.36% or 107 people from the previous year. Whereas Franklin County, Henry County, and Randolph County maintained a labor force of over 10,000 people in August 2020. The remaining counties had a much smaller labor force than that. Randolph County saw the greatest growth of 3.95% in the January to August monthly average, while Fayette County recorded the greatest related decline of 2.11%. On the other hand, the corresponding labor force monthly average for the region was 95,570 people, up by 0.59% or 561 people from 2021. Over the first 6 months in 2022, Fayette County had the highest average monthly unemployment rate of 4%, while all the other counties had that as 2.88% or below. All the counties had a lower average monthly unemployment rate as compared with the same period of the previous year. While Wayne County recovered the most from the unemployment rate average, minus 1.29% from 4.16%, Union County improved the least, minus 0.56% from its already low monthly average of 2.83%. The overall 8-month monthly unemployment rate average of the region of 2.75% was about the same as the state of Indiana of 2.79%, but compared favorably with that of the US of 3.8%. Comparing the first quarter employment between 2021 and 2022, the region added 1,765 new jobs to the private sectors in 2022, with the greatest contributions from manufacturing and healthcare and social services, followed by transportation and warehousing and construction. Other sectors that have expanded by more than 100 jobs in the region included retail trade, professional, scientific, and telecom, as well as arts, entertainment, and recreation, and other services, except public administration. On the other hand, agriculture, forestry, fishing, and hunting led the other sectors in losing the most jobs, followed by administration, support, waste management, and remediation. The weekly wages of the private sectors in the region overall increased by an average rate of 7.33% in the same period of 2022. The management of companies and enterprises sector experienced the highest growth of 41.95%, while the arts, entertainment, and remediation sector underwent the greatest drop of 14.46% in the region. Other sectors that suffered a decline in weekly wages were agriculture, forestry, fishing and hunting, and information. The remaining sectors all have been through a rise in weekly wages from 0.15% to 14.68%. As for the housing market, over the first 8 months in 2022, Randolph County saw the greatest rise in both new listings, plus 20.7% to 181 homes, and closed sales plus 26.4% to 163 homes, while Union County experienced the greatest decline in them, minus 69.2% to 4 homes, and minus 57.1% to 3 homes, respectively, when comparing with the same period of the previous year. All counties in the region recorded an increase in the housing median price, ranging from the lowest by Franklin County, plus 6.3% to $243,000, to the highest by Union County, plus 139.2% to $215,000. The cost of sales to new listings ratios of the counties suggest that Henry County, 96.96%, had the fastest inventory-going housing market in 2022, and Fayette County, 74.1% had the slowest market in the region. The counties compared favorably with the entire state of Indiana were Randolph County and Wayne County, in addition to Henry County. The IUE's Regional Business Confidence Index and its sub-indexes, composed from the responses to the annual business survey conducted to the business operators in the region, all declined in 2022. The index went down by 3.6% to 88.58 points, indicating that the businesses in the region had less confidence in doing business in 2022 as compared with the year before. At the same time, its present situation sub-index, 83.49 points this year, was down by 2.6%, while its expectation sub-index, 91.44 points this year, also dropped by 5.1%. Both declines suggest that those surveyed businesses in the region did experience a worse year 2022 than the year before. And they were also having a worse outlook for 2023 than the outlook they had for 2022 1 year ago. From the survey results or the responses from the participants, we find that over half of the surveyed businesses were able to increase their production or business activities in 2022. Only about 15% of them were hiring fewer employees, and less than 1/10 reduced their capital investment. Although more than 85% of the businesses has suffered from an increase in their costs of doing business by either a significant increase of more than 5% or a slight increase of less than 5%. Only about 1/3 of them has seen a decline in their profitability. Looking forward to 2023, more than 4/5 of the surveyed businesses expect to increase or maintain their production or business activities, whereas 61.8% of the businesses anticipated to maintain their employment level. Only less than 1/10 have planned on reducing their number of employees, but more than 3/10 anticipated to hiring more employees. Over 90% of the businesses planned on maintaining or increasing their capital investments. About 3/4 of the businesses expected to see a rise in their profitability or maintain it, despite over 4/5 of the survey participants looked forward to their costs of doing business to increase significantly by more than 5% or slightly by less than 5%. While 1/4 of the surveyed businesses anticipated the same business and economic conditions in 2023, close to half of them were optimistic, and only about 3/10 were pessimistic about the conditions in 2023. Although the impact of COVID-19 on businesses has appeared to weaken gradually, the relatively high inflation and the disruption in the supply chain due to the various reasons continue to present challenges to the business operations in the region. As a result, we project that the unemployment rate for the region will likely spring in a wide range of 3% through 2023. This is all my report for the review of the region and also the unemployment rate forecast for the region for 2023 as well. Thank you.
So let's show some appreciation for our panelists, please. Are there questions? If so, Terry can bring a mic to you, and there we go. Mr. Van Fleet.
I'd like to propose a question to the entire panel, the intellectual firepower, the collective group. But one of the things I notice about our area, and it always concerns me, and I would love to hear your observations, is that this area continues to depopulate. In the year 2000, Richmond was 8% larger than it is now. And compared to our peers in this area, our performance in terms of population growth continues to shrink. I suspicion that has a whole host of negative economic implications, and it worries me. So I throw this out to the panel in general. What kind of observation trends do you see with that type of performance?
I'll take a stab coming at it from the opposite direction. It comes back, it's more about what can you do, right? Obviously, you can get into a very negative spiral. The tax base falls, you have fewer public resources. The public resources are what are needed to make it an attractive place, whether that's education, public safety, parks. So to decrease that type of spiral it puts a huge burden on leadership. And so, you know, I could spout off a bunch of economic investments to make, but if you do not have municipal and the business leadership working together to set a vision and a strategy for a region, you'll continue to depopulate, right? It's like a business. If a business does not have a strategy based on a brand, it doesn't go anywhere, right? Their competitors take over, competitors become more compelling in the marketplace, and consumers walk away, and ultimately that company is either bought or just fades off into history through a sell-off or bankruptcy. Same thing with geographic regions. The way that you stop depopulation is to set a strategy. And you know you have a strategy when you're willing to say no to opportunities, right? So setting that to the side, had the pleasure of sitting in Kokomo this time yesterday morning. And when you study the history of Kokomo, coming out of 2008, one of the worst communities hit in the nation by the economic retrenchment of 2008. Not only did you have the impact on just general equity financial markets impact, but you had, that's when a lot of those companies in Howard County went bankrupt. And 10 years or 13 years later, they've attracted one of the biggest battery plants in the country, $2.5 billion investment in Howard County. Their population was expected to go down, but they're expected to increase their population by a few thousand here in the next couple of years. And housing prices are going up. So what Richmond has undergone, the good news is you're not alone. It's not unique. But there are stories of how regions turn themselves around. And it's a lot of work, but it can also be very inspiring. And so, and Kokomo did it. They've got an IU campus. They've got they kind of have their own geographic identity. They're far enough away from Indianapolis. So again, this is a great community, but the history of regions would tell us what is Greater Richmond's strategy, and then how are you going to market that? And that's a whole nother debate. But that would be my best answer to your well-placed question.
Could I add 2 cents? I know that, Valerie, if I am not correct me. I know that the EDC of Wayne County area has been very active in joining other counties in joining our neighboring counties in particularly two collaborations. One is the East Central Indiana Regional Partnership, and then other one is the Eastern Indiana Regional Planning Commission. So these 2 groups, they are working hard in attracting and retaining quality workers to the region. So one of the major challenge of the business in the region is how to get the quality workers for their jobs. And EDC is working very hard on this, and I am sure once we can get the good quality workers in the region, it would be easier for us to attract the business, not just the small one, but also the bigger one to the region. And then once other people outside of the region or even in the region, if they think that they will have better chance to get a good job in this region, they will move back to this region. And for those who are staying here, they do not need to look for jobs elsewhere, and they will be happy to stay in this region. And hopefully this will help getting the population of the region higher than before. And then once we have a bigger population, we have a bigger market and to support the business operations in this area.
Good morning. Thank you for all of the information. Although it's not what we want to hear, it's what we need to hear, so thank you for that. I have an observation that was presented in a recent meeting that I sat in regarding what's called Opportunity Youth. And this is a youth serving organization, but that they were looking at the ages of 16 to 25-year-olds that are in the area that do not have a job and they're not in school. And they said that in Wayne County, it was identified that there were 900 in that category. So my question is, have you heard about this demographic, and do you have strategies or ideas on how we identify them and how we get them plugged into education and how we get them plugged into open jobs?
I know that this is a common problem across the country, and you know, we as economists tend to think about labor force participation rates and these like abstract numbers, and you do a great job of kind of putting a you know, an identity to that. These are absolutely, and so going back to kind of building on the earlier question, I was thinking about it, as you have a shrinking population, it's really what you're thinking about is how do you maintain levels of productivity with a potentially shrinking workforce. And the population is obviously kind of a broader category, but you think about the workforce, right? And so is that population, you know, retirees that are moving away, or is it working age folks who are going and seeking opportunities elsewhere, or is it college students who are going, you know, somewhere else and then not returning, the so-called brain drain? I do think that pretty much every Indiana community faces that demographic that exists of young folks who are not really participating in the economy in a helpful way. A lot of communities are really leaning into that technical training. Is it, you know, what's going to give them the skills? Because, you know, most 19-year-olds, if they're not in school, and, you know, a lot of them haven't finished high school, and what value, it's really hard to get productivity out of them. And productivity, again, sounds like a harsh word, but, you know, it's not, it doesn't really help Richmond to have, you know, more folks working in that low-end service sector. What we need are folks with significant skills. I think that goes back to Phil's comments earlier about really leaning into that workforce development piece at all levels. It's an area that the state ought to be spending money and allocating funds for, and whether that's, regional training, all sorts of IU East is a great example of that. The various Ivy Tech campuses, developing those skills and really trying to bridge that gap, I think, is critical to maintaining that economic growth. But maybe some of my colleagues have better, more specific ways to really accomplish that.
Good answer.
Yeah.
It's
I was gonna say.
a tough one.
Thank you very much to the panel for your analysis and the comments. I know Indiana, or you mentioned Michigan and Ohio and so on, the states focused mostly on manufacturing. But what can these states do to move on to sort of higher grade and type of service industries? And that, of course, requires talent as well, but especially for these small communities, how they can be sort of attracting the business and attracting and retaining the talent into less, let's say, sort of manufacturing intensive industries, but higher quality service.
So every region, just like every country, has a comparative advantage. Something they're good at for whatever the geography or the history, the legacy, right? I would take manufacturing and look at it a little more broadly, right? Manufacturing is, and I speak about it in the most broadest terms, right? It serves a lot of industries. It's about making stuff, basically manufacturing about products, right? And then, so whether we like it or not, we have a comparative advantage in making stuff, right? So the question is, how do you create an ecosystem so that you increase productivity, or that you create entrepreneurship around that, right? Automation is a perfect example, right? Advanced manufacturing wages are as good as the best service sectors, right? Advanced manufacturing, though, is not the old style manufacturing where you're hiring folks that just got a high school degree. These need engineers and technically trained folks, or folks that have, high school degree but really good technical training, an apprenticeship, or something below baccalaureate level. So I guess my response is, you take what you're good at. We're good at manufacturing, but then how do we surround that with an entrepreneurial and technologically focused economy? And that could be a combination of attracting businesses from other places, developing the talent that is there, and then incentivizing business around what you're really good at. Indiana is really good at life sciences, right? That's probably our highest value add manufacturing outside of the heavy industrial stuff. And there's healthcare and life sciences is 18% of the economy. That's something that you can link to some of the healthcare services. So it's about linkages. It's about building off what you already have a comparative advantage in, but just moving up in terms of being more productive, embracing automation, embracing the Internet of Things, embracing the things that make production more 21st century.
One thing, if I could add to that, and forgive me because a year ago, and I see a lot of familiar faces here, one of the questions that came from the audience, likely one of you, so again, forgive me if but you asked about I think it was a banking saying that some of the Indianapolis banks were coming out here and trying to hire workers because they could work remotely. And I think there's going to be a transition, we're seeing it already, but trying to identify how communities like Richmond and the area take advantage of the remote work possibilities. And that might be the ability to, do it. And you may not love having talented folks living here in Richmond working for organizations that are outside of the area, right? But there's also the potential benefit that way, where, does that maintain an economic base here? Does that help keep the population here of educated folks still living in Richmond, contributing to the community, even as they're working in a more national or global organizations? So if I were in economic development, I'd be thinking about how can we leverage some of that, where we have some businesses are located here, but maybe workers are in other parts of the state or the country, and vice versa. And if that's something that there can be a strong infrastructure for that, I see that as potentially being beneficial, because Richmond has a lot of opportunities. It's got a lot of advantages. It's got benefits in affordability and accessibility and things that can draw folks here.
And also, one thing the manufacturing industry can do is trying to move up, focusing more on designing higher quality products. So even because higher quality products can sell for high price, and then even if the mechanic part itself is maybe it's shrinking a little bit, but they can still make up for, the revenue can still make up for the loss of revenue of those parts, because they can sell the products at a high price.
I may like to add something to that. I go back to what Phil said. We have to get a clearly defined strategy. And for a number of years in this community, I've been trying to get them to think on a regional basis. We are ideally located right at the borderline here, and we haven't fully exploited the regional advantages, comparatively speaking. And it goes back to overall strategy, quality of education, labor force participation, blah, blah, blah. And you have it, baby.
I'll second that motion.
I'll have to add to that strategy piece. So I'm from Randolph County, and I'm from Randolph County United. I'm president and CEO. And what we did, we combined our economic development, our tourism, and our business and chambers together all in one. And we work with all the community leaders and businesses, and we have a very strong board. And if you recognize on the stats that she had presented, Randolph County was on top of those, because the last 2 years we have put that strategy together, and we have created something that has built Randolph County to where now it's actually showing proof that it works. And we're starting to retain our talent. So just kind of a plug for the strategy piece.
I was going to ask Kyle, and others can join in, and I don't know, maybe it's my own perspective, but as I look at the economy, all I hear about is the stock market. I used to think the U.S. had an economy, and now I think it's just the stock market. And I don't know when that alignment occurred. It's so reactionary. For instance, and you mentioned data points, and it'll go up 300 or 400 points. Everybody's waiting for a pivot and the slightest good news so that our portfolios will rise. It worries me because I thought we were much broader than that. I thought the stock market was a foundational brick in a large foundation of a U.S. economy. But I get a sense that it's now becoming all the stock market. And again, it's probably just me, but I would just be curious to your reaction to that, because I don't know, that seems a mercurial basis for your national destiny to just be on the stock market.
I think that's fair. I think there's two components to it. Obviously, we all to some extent care about the stock market because it's in this day and age, right? Like the days of the pension plan and the defined benefit plans are done with. And so each of us, for better or for worse, is dependent upon the stock market to some extent for our retirements. And so those are very real things. I also think that and I'll remind you that I was asked to give the financial markets outlook, so that's my perspective here today. But I think that the stock market and broader financial markets also do serve as an indicator for where the economy is heading. And so I think there's value in paying attention to that, because the stock market is made up of lots of very smart traders who are out there trying to figure out where corporate earnings are going. And where corporate earnings are going will also help us identify where the jobs market is going. And so I do think it serves as a good indicator and predictor of where we're heading. And that was kind of my reaction to, we're seeing the stock market down significantly this year, and that is one of those leading indicators of where the economy is heading more broadly. So that Wall Street to Main Street connection, I think, exists, and there's value in it. I agree with your point that, next week the stock market can be up 5% or down 5%, and that's right, don't open this, right? Like it doesn't, those short-term fluctuations, on the one hand, we shouldn't pay very much attention to, but as economists who are trying to see what path we're on, it does provide some information.
Thank you. This concludes this year's Outlook panel. I would like to acknowledge the sponsors of this event: Indiana University East School of Business and Economics, the IU East Business and Economic Research Center, the IU Kelley School of Business, and the Regional East Region Chapter of the IU Alumni Association. I'd like to thank our panelists for sharing such insights, and I'd also like to thank each of you for attending and spending your morning on our campus. We look forward to seeing you again soon. Have a wonderful day. Thank you.